Hello and welcome back to the Wall Street Petting Zoo. I'm Christopher Smith,
And I'm Robert Coburn.
and this is our This Week at the Zoo segment in which we review the previous week's market news and look forward to the coming week. And this week, Robert, we had a short trading week due to Good Friday, and it was a pretty good Friday for stock traders because the S&P 500 ended the week up over 12% in 4 days.
Yeah, and we started the week Monday with a 7% gain, partly on the news that the spread of coronavirus is finally slowing down in the United States, and partly on the expectation of a deal between Saudi Arabia and Russia to end their price war and cut oil production. The rally happened despite major problems with the rollout of the federal small business loan program, which is supposed to help small businesses pay their mortgages and keep families on payroll. Several major banks, including Bank of America and Wells Fargo, have been refusing to lend the money despite government guarantees to forgive the loans because most of the small businesses applying for the loans don't have good credit. And another headwind Monday was that there were signs of stress in the credit market, with several major companies declaring bankruptcy and Argentina defaulting on billions of dollars of sovereign debt. One of the big winners Monday was JP Morgan because the JP Morgan CEO said in a letter to shareholders that the company has a fortress balance sheet and can maintain its dividend even if GDP drops by 32%. By the end of the week, JP Morgan gained over 22%.
Yeah, huge week for JP Morgan there. Tuesday, the S&P 500 opened higher, but it ended the day slightly down for the day. One of the winners on Tuesday was AT&T, which announced that it has a strong cash position and that it too will maintain its quarterly dividend, which helps alleviate some investor fears that the dividends would be cut on some of these S&P 500 companies. And in fact, one of the major stories on Wall Street this week was that dividends are quite a bit stronger than investors had feared, with a number of companies announcing that dividend maintenance is a high priority and that they have the cash to keep their dividends going this year.
And on Wednesday, the S&P 500 moved 3.5% higher despite a 17% drop in new mortgage applications. The number may not have been as bad as investors expected because real estate stocks actually ended higher for the day. Another big winner for the day was Tesla, which rolled out its new ventilator design. Tesla is using car parts to build ventilators for hospitals that have a shortage during the coronavirus crisis.
Yeah, and then Thursday, the Fed announced that it's going to do $2.3 trillion worth of loans and programs geared towards small and medium sized businesses. So, $2.3 trillion more stimulus. That was alongside news for the day that unemployment was up another 6.6 million, totaling about 16 million so far in the crisis. This is a record week in jobless claims. But despite the record jobless claims numbers, most of the market reacted positively to the stimulus news and ended the trading week on Thursday higher as the market was closed in observance of Good Friday. Another development that happened late on Thursday afternoon, was that Russia and Saudi Arabia finally announced a deal to cut oil production by 10 million barrels per day. If you recall, Trump originally forecasted that they would cut by between 10 million and 15 million barrels. So this cut came at the low end of what he had promised. And also, Saudi Arabia insisted on using its sort of it has been increasing production during this price war. So it insisted on using the higher benchmark, the increased production as the benchmark for that 10 million barrel production cut. So this is not 10 million barrels off of their normal level of production. This is 10 million barrels off of their elevated level of production during the price war. So overall, I think that this production cut came in less than investors were expecting and hoping for, because oil prices dropped by 11% on Thursday evening. So we saw a pretty negative reaction really to that deal in the oil market. Analysts are expecting demand to fall another 12 million barrels per day over the next month. So the production cuts aren't even going to keep up with the reduction in demand that's expected this month.
Yeah, with a glimmer of signs that the virus is slowing down, especially in the two most hard-hit states, California and New York. Did Trump actually call it somewhat correctly when he said he forecasted reopening the economy after Easter? And I think at this point in time, it is a bit premature to assume we are in the clear and on the road to recovery. Next week is the start of corporate earnings season, and I get the feeling we are going to see a lot of negative earnings and dreary forecasting. I think it's going to be very sombering, and I think the market is going to get dragged down as we start to see the reality of the economic impact the coronavirus has had on big businesses.
Yeah, I mean, the reality is that in order to really flatten the curve, we can't immediately open the economy at the very first sign of a slowdown in the spread of the virus. We're going to have to stay home through at least the end of April, and a lot of people are talking about the end of May. So the market's reaction is going to depend largely on what public officials signal as far as how long these quarantines are going to last. I think the market got really optimistic this week at the first signs of a coronavirus slowdown, but it probably got too optimistic too fast. We're sitting right now underneath an important technical resistance level, the 50-day moving average for the S&P 500 at 2810 points, 2,810 points. And if the S&P 500 can close on Monday above 2810, then we might see a continuation of this uptrend next week. But if it gets rejected from that level on Monday and closes below 2810 on Monday, then I would expect to see a move downward for most of next week. So a lot of how the market reacts next week is going to depend on what we do with this technical resistance level on Monday. Um, so keep an eye on that level in the S&P 500 2810. Let's talk stocks that we watched this week. Robert, what were you watching?
Well, unfortunately, I was out last week, but the week prior, I did call out that I was watching Bitcoin, and there has been quite a bit of movement since then. We are roughly 31 days away from the upcoming Bitcoin halving, and the volatility shows. Bitcoin went above and fell below the 7,000 mark this week, and we could see another huge dip below the 5,000 mark before it could potentially shoot up again as we lead into the following weeks. I would not advise putting money into Bitcoin at this point in time unless you have a leprechaun or the money you are spending is the same money you are going to gamble away in Vegas, but you can't since, the casinos are closed.
Yeah. Last week, I watched Bristol Myers Squibb, which is a pharmaceutical company, and the oil tanker company Frontline Limited. And they both had a pretty strong week. Bristol Myers gained over 6% for the week, and Frontline gained a little over 11%, especially at the end of the week as those oil prices came down. If you recall, I have been forecasting that Frontline would move in the opposite direction of oil prices. So Frontline gained and oil fell. So both companies did have a strong week, but both also underperformed the market slightly. The S&P 500 having gained 12%. So those were not the best picks this week. The best pick would have just been to buy the S&P 500, as is often the case. I've also been watching gold, which ended the week up 4%. We're now slightly above an important technical support level. So I suspect that gold will continue upward this week. What are you watching this week, Robert?
This week, I'm going to be watching Dollar General and Dollar Tree. Now, both these companies are practically mirror images of themselves on the outside. But if you look at their charts, they are vastly different, with Dollar General being up and Dollar Tree being down. JP Morgan has raised its price target for Dollar General, whereas they have cut it for Dollar Tree. Dollar Tree has always been weaker as it tends to lag behind Dollar General, which is shown in their previous earnings reports. Now, why would I be watching these two stocks? Well, on the long, and let me emphasize long road we have to economic recovery, dollar stores tend to do really well as many people will be living on a very tight budget during this economic recovery. Dollar General has yet to pull its guidance in face of the coronavirus compared to Dollar Tree. However, I think they will raise their guidance on their next earnings report, which should be near the tail end of next month.
Yeah, I was just reading an article, Robert, because we were talking about this before the podcast about whether all those jobs that have been cut are going to come back and how fast they might come back. And I was just reading an article where some analysts were forecasting that we might not see those jobs come back until 2023. And in the meantime, we may see double digit unemployment. So we're probably going to have a lot of people living on pretty tight budgets in the near future as the global economy slows down over the next couple of years. So probably pretty good bets there on the discount stores. Honestly, I think the market is really hard to predict from here. I've seen mixed reviews of how fast the jobs are going to come back. The one I was just talking about is a pessimistic view, but I also saw an optimistic view from Zacks that's forecasting that the jobs will come back very quickly after the economy reopens. And I'm seeing a lot of that sort of very mixed views out there. Some people extremely optimistic that everything is basically just going to return to normal and the stimulus is going to work as advertised, and other people quite pessimistic. Honestly, I don't even really have a hunch about what's going to happen in the next few months, economically speaking. I think we're at the very least going to see some weakening as the global economy slows down. But with the stimulus, I really don't know how it's working and what the outcomes are going to be. We did see a few bankruptcies early this week, as we mentioned in our news review, but those bankruptcies were mostly private companies, not publicly traded companies, or they were companies that are traded on foreign stock exchanges, not US stock exchanges. And we haven't seen the kind of bankruptcies from US publicly traded companies that I expected to see at this point, which tells me that the federal stimulus is working at least partly as advertised. On the other hand, I've been watching articles from some of the monetary policy people who say that the stimulus from the Fed has been mostly aimed at increasing bank reserves. And that's not actually working as advertised because the banks, even though they have larger reserves, aren't willing to lend more money to people because nobody has collateral for borrowing. The monetary policy people seem to think that the liquidity crisis is not over yet, and that the stimulus is not working entirely as advertised. So I really don't know. In my opinion, we have rallied a little too far too fast. So overall, I have a bearish bias from here, but mostly I am just sort of waiting to see what the economic data and the earnings picture looks like. One thing I am long on right now is gold. The Fed announced Thursday that it's doing another $2.3 trillion of stimulus. And part of that announcement was that it's going to start buying junk bonds. Up to this point, the Fed has only been buying investment grade corporate bonds. So for them to start buying junk grade bonds is really interesting. I think that this is going to be probably really good for stocks because those junk grade bonds, or the junk grade companies, have been the ones that are really in danger, and the Fed needs to address them, not just the investment grade companies. And so this is going to help prevent a lot of bankruptcies, probably the Fed buying these junk grade bonds, but it exposes the Fed to a lot of default risk if these companies should be unable to repay these bonds. And I'm not entirely sure how that will affect the federal government. It's possible that the US might get a credit rating downgrade because of all this bad debt that it's holding, but I'm actually not really, I'm not familiar enough with the credit rating process to really know. The Fed is a private bank, even though it's a central bank, which makes it a little bit complicated in terms of how its credit rating relates to the US government's credit rating. So I'm not really sure on that. But one thing that will result from this is should those loans go into default, we might see long term inflation. Because traditionally, when the Fed loans out a bunch of money during a recession, that's a temporary measure. It's injecting a lot of money into the economy, and then it starts unwinding its balance sheet immediately after the recession to take all that money back out of circulation. And so you don't get long term inflation as a result of the money that the Fed has created during the recession. But if the Fed buys a bunch of bad debt and then that debt goes into default, the Fed won't be able to unwind its balance sheet. It won't be able to take that money out of circulation again. So that money would then stay in circulation over the next, however, basically infinite number of years. So we could get a lot more sort of post recession inflation than we did after the last recession. So that might be good for precious metals prices in the long term. So I think gold and silver are possibly good positions to take here. And I wouldn't be surprised to see the gold spot price top $2,000 by the end of the year from its current level near 1700. I've seen a lot of really, really bullish views on gold from monetary policy people who seem to really know what they're talking about. So That's really the only thing that I'm long on right now. The rest of the market, I'm just waiting and seeing.
So you're saying is we're gonna see a lot more commercials for cash for gold
Yeah, I think so. I think there's going to be a lot of
because
that.
that was big in the late 2000, like after the recession in 2008. There was a huge influx in cash for gold commercials. I remember that being like the norm on radio, TV, and internet, and I get the feeling that's coming back.
Yeah, I remember that too, and I've seen some of that during this recession as well. Fun fact, most of the people who do like precious metals trading are trading gold ETFs, and they're not actually handing you physical gold. But the investment advisors who get like felony convictions are banned from doing ETFs and securities and stuff. And so the only thing that they're allowed to trade is physical gold. So a lot of the guys who get like caught for fraud or, get felonies on their record, they become physical gold traders because that's the only thing that they're allowed to do. And they become, a lot of those commercials that you see on TV basically is these guys with felonies who aren't allowed to trade securities out there trying to push like physical gold. So those probably are not the people that you want to be doing business with. You probably just stick to the ETFs.
Yeah, and I think a lot of people already rated their parents and grandparents' jewelry boxes for the gold last time, so I'm not sure if there's going to be that much left around this time.
There is a supply crunch right now, because a lot of mines have been closed down. So we've got a lot of demand for gold and silver right now, but not much being, not much output from the mines and the refiners. So that's another reason that gold is a pretty. It's a bull market in gold right now. All right, folks, if you heard anything on this podcast that you found useful, please give us a like, share, or comment on YouTube. You can like us on Facebook. You can like us on Twitter. Follow us on Twitter. And we would love to hear from you if you have any feedback on our videos. And we also have a referral link for Webull underneath the YouTube video. If you click that link and then deposit $100 into a Webull account for the first time, you will get some free stocks. We will get some free stocks that help support the podcast. That would be really, really great. We really appreciate all of your support, and we are really happy about you guys getting the word out. We're seeing our subscriber count climb somewhat, and it's really encouraging. And that's why we are continuing to make these videos. But we would really appreciate your support for more of that. Hey, guys, thanks so much. And stay safe out there, both in terms of your money and in terms of staying safe from the virus, wearing your face mask and doing your social distancing and washing your hands. We got to stick this out for another good month. Uh, so hang in there.
Yeah, and don't forget this week we'll probably be doing another live podcast, or not podcast, but a live, type of Q&A session that we did last time on Facebook. So keep an eye out for any news on that. It'll probably be Wednesday or Thursday, but we'll announce it on Twitter as well as on our Facebook page.
Yeah, go follow our Facebook page. It's just Wall Street Petting Zoo. You can just find it through the search feature. We'd love to see you on there.
See ya.
Hey, thanks so much, and we will see you back at the zoo next week.